and welcome everybody. We have, I think we have everybody on the group now. Brett James, who is one of the staff at the IAASB, is going to help me take some notes as we go through. I'm looking forward to a engaging discussion, and those notes will help us when we go back into the bigger session to collaborate and talk about the issues. I also have some other board members on the session this morning. I have Sue Almond from UK, she's a board member. Denise Weber is a technical advisor of the board. And I think Isabel might be here, I'm not sure. Oh, hi Isabel, yeah, you're there as well. So welcome. And we have a number of observers, which I see you've all had your cameras on, so that's great. So feel free to participate as we go through and talk through the questions. I think what probably makes sense, instead of going around and introducing everyone at the start, is when you make your first comment or contribution, if you can just say who you are and what group you're representing, that would be probably the easiest way to go, if that's okay. Okay, so with that, I'm going to jump right into the questions. Hopefully you've had a chance to take a look through the discussion paper that was sent out prior to the session. It outlines some of the key points from the issued discussion paper and the questions that we're going to talk about today. And the first session, as mentioned, is on fraud and going concern. I think, Brett, you're putting the questions up. Great. So we're going to walk through these 5 questions first. Hopefully we'll get some good discussion going, and yeah, we'll just get started. And I am going to jump around a little bit here because some of the questions deal with fraud singularly, and some of them deal with fraud and going concern. So I'll just make sure I call that out when I get to the questions. And the first question is really to gather your thoughts on what do you think is the main cause of the expectation gap? And that question relates both to fraud and going concern as it is in the audit of financial statements. So big question, but if we could open it up to the group, I'd love to hear some of your comments.
Julie, shall I go first? It's Charles Henderson.
Yeah, sure.
Okay. I think some of you might know me like Sue Almond, but I used to work for Invesco as a fund management executive, supporting or working closely with fund managers on corporate governance and finance. I'm currently a director of the UK Shareholders Association, which is a sort of voluntary member association looking after the interests of private investors. And I'm also a member of the UK's FRC Audit Quality Review Committee. So I'm coming at this from a generalist, knowledgeable market and financial reporting ecosystem participant and regular user of financial statements. So pretty much an investor perspective. I think the expectation gap mainly arises from what came up on the slides previously as the knowledge gap, much more so than the other two, the performance gap and the evolution gap. And so I think that the public thinks or expects auditors to do stuff, and they're probably not actually tasked to do that. And I think until recently, probably until prompted by the media to think that auditors are not doing a good job in relation to corporate failures, I think until recently the public have been happy to leave it to the experts to decide what should be done within audits. And I think to a large extent, this is because the experts, the auditors themselves, are much better able to collectively come up with sort of thoughts and processes around auditing that would help the auditing process and do what it's supposed to do, as opposed to the disparate group of users of audits, because they'll probably think a huge range of different things in terms of what they expect audits to do. So sort of trying to collectively pull that together and their expectations is immensely difficult. I think in respect of fraud, the public expects auditors to discover them, but I think that's much harder than the people within companies to do, and and also the people within companies should be held much more accountable for frauds in those companies. But auditors do have a responsibility to try and discover material misstatements in financial statements, including those coming from fraud. So they should do what they can to do that. In respect of going concern, again, I think it's the people within the companies who have major responsibility to profess whether an organisation is a going concern and is viable, depending on jurisdictions that also report on viability. But again, I think auditors should just be assessing that assessment. But I think one of the things that they don't do currently, which they probably could do a better job on, is actually look at external signals or red flags for corporate failure and follow those up and explain how they've done that. I also think they should, auditors could much more interact with users of audits, especially during the planning stage, to see what they're expecting in terms of audit and going concern, and have a iterative two-way dialogue in terms of how what the users are expecting from an audit.
Okay, great. Others' views?
Yeah, hello. Hello, each one. It's Valdir Koskodai. Very nice to see some of friends here. Megan, Isabel, Jim, Brad. Let me see if there are others. Very nice to meet you here. And I'm very, how can I say, very happy to be here with you, because I was part of the group that implemented the report in 2015. So it was a great time, and I think that IAASB is doing a very good job in doing this post-implementation review, and in fact, there's nothing to say the contrary, and there is an expectation gap. We have to, how can I say, to agree with this. I believe that there's this expectation gap, and I have been living with the evolution gap. That's not, if you go through that three categories, the evolution gap in the financial reporting ecosystem prepares, as we found that time, prepares and even regulators in some station argue that more information about continuity, especially in the financial sector, can create problems with creditors. And I have been discussing this with clients and others in the practice, and problems of giving creditors to entities. So there is a very strong resistance from the IAASB in London to change the IFRS framework. And IFRS is the most used framework in the world. The financial statements or the financial report framework, like IFRS, require the management to make assessment of the entity's ability to continue the going concern. Of course, we have something there. But however, these frameworks provide little guidance to what important analysis or details need to be disclosed. And regarding those charged with governance, what assessments should be made in the level of detail analysis, and that may be required to make this assessment. So only with more information will the auditor be able to extend his work as well as the disclosures in the report. I continue to believe that the auditor cannot be the primary source of the information. So in order to have more information about liquidity, about going concern, more disclosures, more work must be done by the management, by those charged with governance. So I think that IAASB should continue to try to improve the disclosures in contact with the regulators and standard setters. And regarding fraud, when we talk about transparency, we talk about auditor report, in my point of view. Although some actions can be done in order to reinforce skepticism in the standards, transparency must move together with some other improvements that's not in the auditor control. Here again, we have questions of understanding the requirements of the management those charged with governance. I would say that because I do not believe that it's appropriate for the auditing standards to require the auditor to demand from the entity things that the legislation or regulation does not require, nor can the auditor, through his report, be the primary source of the information. The things such as whether or not establish compliance departments, hotlines, duty to report to the regulator certain events may vary from country to country, from regulator to regulator. So the movement here is another thing that must respect what we have in the territories, the legislation requirements. So I think that we can go further. We can improve something in the standards, but again, the IAASB should not go beyond what is required by legislation, by the law. So the auditor cannot deal with this alone. What we can do is to analyze whether management, governance, and compliance with the law and regulations. Thank you.
Jim?
Hello, everyone. I'm Jim Silf. I'm a retired partner in Ernst & Young, Toronto. After that, I spent 15 years setting auditing standards, both nationally and internationally. So I recognize many of your faces on this call. I was encouraged and intrigued by what Charles said in his comments about the fact that auditors are doing a good job. That's great to hear, because I don't think that they are. I think that the expectation gap arises because, as Charles said, people outside of our profession, users of financial statements, expect auditors to find material fraud. And we have too many cases where material fraud seems not to be found for 5 or 6 years. And like every situation, it's not the 500 frauds that auditors did find before the audited financial statements were issued. It's the 5 frauds that were not found that get all of the press. The 5 frauds that are related in this document that we're looking at as part of this meeting. Huge frauds, obviously cleverly concealed, but the expectation gap arises because auditors did not find them. So I think that the IFIAR members around the world continuously find that auditors have not met auditing standards to their satisfaction. So I think a significant part of this problem is first and foremost performance. And I know there's a discussion about should we have forensic auditors on every audit team. I don't think that's the way to go, because you can't have that many forensic auditors in the world to have a forensic auditor on every audit team. So you're either going to eliminate many audit firms from around the world, or you're going to have many who claim to have a forensic specialist, but not everyone is going to be a forensic auditing specialist. I do agree with Charles's comment that people should be held more accountable. And that's not something the IAASB can do. It's not something that the International Accounting Standards Board can do. It is what regulators can do. Of course, at the end of the day, the only people that have money after a fraud are the audit firms. So we're the easy target to be sued and blamed, while generally speaking, management are let free because they've made their money and they've disappeared into the distance, or the amount that they've got left is so irrelevant to the size of the fraud that they've conducted that it doesn't mean much in the big scheme of things. So my biggest concern is, how do we improve performance? And I think that the skepticism, the professional skepticism project is critical, because my observation as an audit partner is it is far too easy for the auditor to assume management's good intentions. And that with all the pressures that you're under as an audit partner, with all of the clients you're dealing with simultaneously, it's too easy to take what you're told by management and accept it. So we've got to get that mindset changed. And if we could find a way of getting every auditor throughout the world to be a lot more skeptical and have enough time to actually delve into management's answers and determine whether they are right or wrong, I think we'd close the expectation gap a little, not completely, but a little.
Other views on question 1? Megan?
Thanks. Sorry, I thought I had to unmute twice. So thanks, everybody. I'm Megan Zetzman. I'm the Chief Auditor at the PCAOB. Prior to that, I was a partner at Deloitte. Yeah, this is certainly really interesting. Actually, maybe before I get started, I also should just give the standard disclaimer that what I'm going to say today are my remarks. They're not those of the board or the members of the board or any of the staff. So it's interesting. This is really interesting, and I thought the poll was really interesting. The fact that actually nobody pointed out the fact that the standards are broken, although you could argue that maybe some of the people who put all in the above thought a little bit about that. And then I think the remarks of my fellow Breakout members here are, I actually agree with just about everything that everybody has said. I think if this was easily pointed to one particular piece of the expectation gap, it probably would have been discovered before and maybe it would have been solved. So I think it really is very complex and multifaceted. So I thought what Charles was talking about was really interesting in terms of, sort of it really being the knowledge gap. And I really do think that is a big part of it. And then along with that comes the, the sort of the accountabilities, and maybe it was maybe I'm straying into some of the other questions, but the roles of everybody within that financial reporting ecosystem. So obviously in the US, our environment is probably a little different for many different reasons. We obviously have a very litigious society here, but we also have things like the Sarbanes-Oxley Act, which put, at least for listed companies, put a lot more onus on the responsibilities of management, the reporting on controls, and things like that. So there certainly are some in the US that would say that a lot of what's happened in the US, and the fact that maybe you could say that there are not as many bad frauds in the US. I don't know if that's true or not, but certainly when you look at some of the more recent, I would say sort of spectacular headlines, they have been outside of the US. So does that mean that Sarbanes-Oxley is working? I don't know. Certainly that there's no fraud here in the US, but the environment is a little bit different. And I think actually even on the going concern side of things, when you look to the requirements that sit in the FASB's accounting framework, they're far more specific than what sits in IFRS. So, I think Valdir's comments around what is in IFRS and what's not are also really interesting. And, that fundamental premise of the auditor shouldn't be the provider of original information, or how far do you stress that? That obviously becomes much more difficult when there isn't a robust framework. And the one thing that we have, one data point I can just throw out is, as part of, I guess, surviving in the current environment, we've been spending quite a lot of time talking to firms and seeing what they're doing and what kind of guidance they're producing for their teams, and how that's all playing out in the, kind of in the real world. And one of the things we did here was that the accounting framework is actually holding up fairly well. And that's really prompting companies to think quite thoughtfully about going concern assessments and really think through that process of figuring out. And obviously the terms in US GAAP are a little bit different, but thinking about whether substantial doubt exists and management's plans, and then there are robust requirements for disclosures. So there's a lot of focus on management to do that, to have the right controls around all of it. And I'm not going to say it makes the auditing easy, because this is obviously not easy auditing, but it creates maybe more of a framework or a structure to support the auditing. So that's interesting, because I think that's obviously a difference between the US environment versus maybe other places around the world. So I think there's lots of different things that could be looked at here. I think it's a really interesting initiative. I'd also agree with Jim, though, when you start to think about is this the performance gap? I wouldn't say that it's purely a performance gap, but I think there obviously has to be some aspect of performance that's related to it. And at least for me, thinking about what was the topics covered in the prior roundtable around use of fraud, use of technology, and that's not just to perpetrate fraud, but it's also for the auditor to be able to use that technology to have a better ability to actually detect fraud. And I think obviously not all auditors are in the same place with respect to how they're doing that. So another thing that we've been doing at the PCAOB is we have a data and technology project, and as part of that project, we've been spending time with a task force and then with firms to look at the different things that they are investing in and the types of technologies that are evolving. And they certainly are in a way better position today using some of the newer technologies to really get to grips with what is going on. Which then brings me, this is the last point, brings me back to think about the standards. And fundamentally, I don't think the standards are broken, but I think that there's probably some room for modernization. And, in particular, when you think about the fraud standard that, everyone kind of runs to, well, here's the three things that I need to do. I need to go and test the journal entries, look at the estimates for bias, and check off the significant unusual transactions, and then I'm done. There's kind of a banner that goes before that, which is think about how to identify, assess, and respond to risks, material misstatement due to fraud. And people seem to sort of, I think, and this goes back many, many years, run to just checking the boxes on those three things. And, something like journal entries, when that standard was written, I don't know how many years it was, the role of journal entries was very different than the role of journal entries today. So, that probably is somewhere where, maybe there is a need for some new guidance or a reminder that, that's not just the stopgap, that there should be a bigger picture think about it.
Thanks, Megan. And I'm gonna move us on to questions 2 or 3, just in the interest of time. And you're right, Megan, we have touched on some of the other ones as we've gone. So thank you for that. Do you have any perspectives on, and I'm going to take them together just because they're largely the same question, just one's on fraud and one's on going concern, but what do you think, or do you have views on what the auditor's responsibility should be with respect to fraud or going concern? And the discussion paper touched on some of those, but I'd be interested in if you have any thoughts to share on question 2 or 3.
Julie, I think one of the things that I struggle with is not being an auditor, so not really having a detailed knowledge of what's in the standards. But I'm going to take from Jim and Megan that there's quite a lot there. And the question, probably from my perspective, is around if Jim thinks there's more of there is a performance gap problem, what is it that auditors are not doing which they're supposed to do? In respect of both fraud and going concern, because from a user perspective, I think in the majority of cases that I've come across, and thank goodness I haven't come across the examples that are in the paper, because when I was with my fund managers, they didn't go anywhere near any of those companies, including Carillion. But I think it's interesting from a European point of view that Wirecard is probably more of a fraud than anything else, and Carillion is more of a going concern issue than anything else. So I think, generally speaking, I wouldn't, from a user perspective, think there is any need to add to the auditor's responsibilities in both fraud and going concern. Unless it's providing clearer requirements in the standards as to what they could do. But as I said earlier, I think in both cases there could be a bit more engagement with users at the planning stage of audits in terms of understanding what they expect to happen just on an audit, and what are the key issues from an audit perspective or from a financial statement perspective there are. and get the auditors to consider what they could do in that respect. And that includes like the suggestions in the Bryden Review in the UK around looking at external signals, red flags of corporate failure, and responding to those.
Yuri?
Hi, I'm Yuri Zwick. I'm a fellow at the Center for Audit Quality here in the U.S. I think consistent with what others have said here, and with the IAASB's current auditing standard, I think we continue to believe that the primary responsibility for the prevention and detection of fraud rests with both those charged with governance and management. And when we think about the responsibilities as outlined in the existing IAASB standard around fraud, they do seem to be appropriate, and even acknowledge that there are situations where that there's limitations around the audit, and that some material misstatements of financial statements may not be detected even when financial statement audits are performed properly. In part likely because each fraud is different and unique, and therefore absent testing 100% of the transactions, it's unlikely that auditors' procedures would ever be able to detect all fraud. And so while more can be done by the auditor to detect material financial statement fraud, such as leveraging technology or performing forensic procedures, as others have highlighted here, we do believe it may be difficult to implement such changes in a manner that wouldn't in some way limit audit firms of all sizes' ability to comply with such changes. Particularly when we think about the forensic audit, I think from our perspective, the procedures in forensic audits are often very different. And I think the discussion paper highlights, some of the points, but maybe just to hit a couple, in forensic audits, oftentimes a fraud is being investigated, and the review can be very targeted, where you may have a sense of what you're looking for right from the beginning, whether that's an allegation, management scope, prior bad acts, information from interviews, and maybe the scope broadens over time, as you start to execute those procedures. But oftentimes the starting point is much more narrow and focused than what you'd find in a financial statement audit, which may be done under like a sampling approach. And such differences in the scope could limit the effectiveness, of any potential broad requirement to include forensic specialists in the financial statement audits. In addition to the other comments I think that were made earlier, just around making sure we have capacity of forensic auditors, right, to do that if that's even feasible. So, and then lastly, I would just say, I think, and I think this was also highlighted in the paper, just in terms of the IAASB's outreach, there was some suggestion around, whether, there could be a separate forensic engagement, where stakeholders maybe are looking for more, possibly in situations where certain risk characteristics are present. And that could be a potential solution. I think, that said, though, when we think about today, management and those charged with governance, do always have a choice to expand the scope of their audit procedures. And often, we don't see that happening very often.
Great, thank you. Others' views on Jim?
Can I interject once more? And I'm
Sure.
trying not to take up too much of the common time here. I was interested in Megan's comments about the accounting standards, or the Sarbanes-Oxley Act in the United States, are forcing management to really confront going concern. I don't think that's true internationally, and it's certainly not true in the SME marketplace. Most entrepreneurs are optimistic about their business, their success, and their continued success. And if there's one thing I can tell you from having talked to our offices around the world over the last 6 months as a result of COVID, I don't think any management thinks their business is going to fail. Their starting point is, we will get through this. And they're not professional managers, they're businessmen and businesswomen who have a product or a service that they're selling. And they either have a government who is supporting them in this time of COVID or not, but they all seem to believe that they're going to get through this just fine. And none of them are coming forward with the discussion about, do we have a going concern problem? If the auditor is not saying, we think you have a going concern problem, prove to me that I am wrong, it's a non-issue. So the challenge is not that the standard is wrong, because I think the standards with respect to the responsibilities for going concern are pretty good. And I agree with Megan, they can be tweaked and fine-tuned, but they're not far off where they should be. But the problem is the recipients, management of these companies are all starting in a different position. And at the private company level, this is a really, really, really difficult issue, because they're often on the knife edge of loan restrictions anyway. And we have all known the history of, if you get a going concern qualification, is that the death knell of your company, and will the lender call the money? These are very difficult discussions to have with every client. And and even with the professional skepticism that I suggested wasn't existing earlier, I think when it does exist, it's the most difficult thing for an auditor to do. And you're trying to be an independent auditor, but you're also trying to help your client who's paying your bill. And you're balancing on that knife edge of trying to do the right thing for everybody. And it's not easy. Thanks. Great,
thank you. I'm going to move to question 4. And question 4 was about transparency. So this would be how could we be more transparent about what the auditor's work is? And this is specific in relation to fraud, because we are going to get to the going concern transparency part in the auditor reporting section. So are there views from the group around whether or not you believe that more transparency is needed about what the auditor does in relation to fraud in the audit?
I think one of the things that could be made more transparent, especially under the changes to audit reporting, and I think we're obviously going to come on to this later on in the second part. But I think, to me, a lot of audit reports at the moment are quite are very cautious and as a result quite bland, and don't give enough detail in terms of especially areas like fraud and going concern. For example, I can't think of one that I've come across that talks about what exactly is the audit approach. Is it a controls testing approach, or is it a substantive approach, or is it a mixture of the two, and what the auditor is trying to do as a result of that approach, and especially in relation to, say, fraud or going concern. And I think a bit more transparency and detail around the process in audit reports would be a lot more helpful, especially to users, and therefore in potentially reducing the expectation gap.
Okay. Other views on the transparency point? Megan?
Yep. Thanks, Julie. I must say it's interesting hearing Charles's perspective, obviously as an investor. I think that it will be interesting for the IAASB to do some of its post-implementation work on the expanded auditors report and see how people are actually using some of the new information that's in there. And on the one hand, I think it's easy to say, yeah, there should be more in the report that would talk about fraud and what the auditor did. I do kind of worry though that it could devolve into sort of a list of a couple of standard procedures, and then it doesn't necessarily become useful. And then I think you also have the challenge that maybe that when the report gets too long, people don't actually read and digest all the different pieces of it. So I don't really know exactly for sure where people would land, but I do just sort of kind of worry about having too much stuff that you could kind of skip over. And I know a lot of that was talked about as the IAASB worked on its auditor reporting standards and expanded the description of auditor responsibilities, but then very quickly it was all that's now a very long piece of the report, and can we put that in an appendix, or is there a way to maybe put that on a website or something like that so that it doesn't overwhelm the other information. So maybe it's a piece of it, but I'm not sure that having more in the auditor's report is necessarily going to go a tremendously long way to solving some of these problems. That's just my personal view.
I think that's a good point that Megan makes, because again, maybe it's my use of language as sort of asking for more information around the processes in trying to discover fraud or assessing going concern. And I agree with Megan, that is not what users want, because they don't want a list of procedures, because in a lot of cases, in a lot of key audit matters, they're getting that at the moment, and it's not exactly helpful because it's not really getting to the heart or nub of the key audit matters from a user point of view, which is what you want to know, whether what the audit has done has ultimately provided confidence in the information that's been provided in the financial statements. So I think, I mean, like any reporting, any business reporting, the key is in trying to think what actually matters to the readers of the report and articulating that. But again, I go back to the fact that at the moment, I think from a user point of view, audit reports are not necessarily that transparent, and they could be more transparent.
Mary Catherine, did I see you wanting to jump in?
Yeah, I was just going to expand on that. And I'm Mary Catherine Kearney. I'm a professional accounting fellow at the Office of the Comptroller of the Currency, which is part of, has a seat on the Basel Committee of Banking Supervision. And I think and before this role, I was an auditor. So I think the struggle with adding more transparency goes back to, you might then widen the knowledge gap, because to Megan's point, how much detail will you end up needing to put into something to appropriately describe the procedures that the auditors performed at a level where the users and investors of those financials can actually understand, comprehend, and get an understanding of what was actually done. And I think that's just something that I would be concerned with, of what level of detail do you go to that's sufficient enough, but that's also not, if everything is appropriate to the material in a material way, that you're not scaring users of the financials and then the public blows something out of proportion and all of a sudden it becomes headline news.
Great, thanks. And Yuri, yeah.
Yep, maybe just a couple of quick points to pile on to what Mary Catherine said. I think, I think from a additional transparency perspective, while it likely could help with the knowledge gap, I think as we've talked about, I think we do just caution around, what level and how specific on the procedures around fraud would you need to be, and would the benefits, outweigh the risks of such approach? Meaning, if you were to publicly report specific audit procedures at that level, would you potentially, be, sort of allowing the potential fraud schemes to evolve as they start to better understand auditors' procedures? And then I think the other point I would make quickly is just, in addition, and I think we touched on it earlier, but such changes could result in a risk that there's a disclosure of information related to fraud that wasn't required by management.
Okay. I've got one more question that we need to chat about, so I'm going to move to that question. And we've touched on it in a couple of places through your commentary already, but the question 5 is really, what in your view could be done by the IAASB or others to narrow the gap? And are there others in the financial reporting ecosystem that have a role to play? And I think a couple of you have already mentioned management. You've mentioned those charged with governance have roles to play. And I guess it's a bit of a general question at the end, if there's anything more that could be done. And speaking from the IAASB perspective, we're certainly interested in views if you have thoughts about what the board could work on.
I was trying to understand what is the expectation gap we are discussing here. That more clarification about what the auditor do is important. I think that the matter, it really doesn't goes just in information, but more I would say that the expectation gap is not transparency, is more work. For example, what we did in the last auditor review, we introduced a section called Going Concern, and we described exactly what we do in audit. And so there is a specific section there, but the expectation gap was not solved. So I think that what we are really discussing here is more work, more responsibility. And again, we need to be cautious on this regard, because as I said before, as some of you are saying, moving to more transparency is not a thing that the auditor can do just alone. So I have to have this in mind. Maybe, and as described in the discussion paper, recent reviews of certain audits have introduced some new requirements or in a new articulation in a way that reinforces skeptical mindset. And as stated in the paper, I do agree that similar improvements should also be considered for the fraud and going concern projects. Another thing that regarding the question, what we can do, I think that regarding fraud, one thing that struggles me is that the rules are clear that in certain cases where you identify fraud, notably involving management, for example, you must take those charged with governance and discuss with them. What we do not have is clarification of how far the auditor should go in this scenario. Usually the entity does internal investigation or hires an investigation team. What type of work and events is expected or evidence that the auditor need to collect at this stage in this scenario? I think that clarification of procedures required when fraud is identified is one thing that we need to discuss and maybe explore a little bit better in standards.
Okay, thank you. And I have this clock that's ticking down, so we don't have much time left. We just have over a minute. But James, if we haven't heard from you, so interested.
Yeah, I'm the Director of Policy Leadership at IAASB, but I'm primarily on this call as my role as a technical advisor to one of the board members in IAASB. And one of the recent projects there was the Inquiring Mind, which really was trying to introduce the professional skepticism concept to professional accountants in business. And I think that's absolutely crucial in this whole fraud debate, because I think one of the key areas is controls. At the moment, if we add additional responsibilities onto auditors, it's like building an extension onto a house where the foundations are not proper. So we really need to focus on the foundations. And so from an IAASB perspective, I think it's crucial to speak to organizations around the world who have an involvement, both in the preparation of financial statements. As was highlighted there, you know, the US gap does appear to be stronger in relation to some of the going concern assessment work that's required in contrast to IFRS. So that could be one organization maybe like to have a discussion. Those charged with governance and a lot of the large investor groups as well. I mean, I've heard Charles's comments today, and I'm very much aligned with what Charles was saying. But you do need to get them on board as well and explain that this is not just an audit problem. This is a problem across the corporate ecosystem. And yes, I would like auditors potentially to do more, but I think first of all, let's focus on the basics. And I do think one of the advantages of the US listed style audit is the focus on internal controls. But even if we didn't have the assurance, as has been considered in the UK at the moment, really placing the focus on directors and making them accountable.